Happy morning to all. Welcome to online class. In my previous video, we shall discuss about the retirement of a partner, particular section D question. In this video also, we shall discuss same the topic sections D question under the chapter of retirement of a partner. So here few new adjustments will be there. According to that adjustment, how we have to treat, we have to discuss in this class only. Next we have to move to the particular question related to the retirement of a partner. So here the question is there. Question number 2. A, B and C, three members are partners sharing profits and losses in the ratio of 2:1. So here three partners are there, Mr. A, Mr. B and Mr. C. Three members are the partners. Their profit sharing ratio is 2:1. In this question they are given a proportion, exact ratio they are given 2:1. That means each partner share how much means 2/5 for A, 2/5 for B and 1/5 for C. So how the 5 will get is 2 plus 2 4, 4 plus 1 you will get 5 totally. So based on that 2/5, 2/5, 1/5 we have to divide it, and after that will be considered as a ratio of the each and every partner. Instead of that, what they are giving, their balance sheet as on 31st March 2020 was as follows. So in here the balance sheet given. So that balance sheet, so few transactions will come to the new account, few transactions will come to the new balance sheet. According to that criteria, we have to make the video. So we have to make the adjustment. So let us discuss about the balance sheet. So in the balance sheet, left hand side, right hand side, both sides they are given. Left hand side liabilities amount, right hand side assets amount they are given. So in the left liability side, creditors they are given. So for this creditor, no adjustment is there. If any adjustment is there, means we have to adjust it in a particular account, that is revaluation account. But here there is no adjustment. This transaction will come to directly to the new balance sheet. Bills payable, which is a current liability. For this also no adjustment they are given. If any adjustments they are given by the particular asset or liabilities, it will come to the particular account, but there is no adjustment. Directly the asset or liability will be affected, will be reflected into the new balance sheet of the particular company. The reserve fund. So we know that reserve is nothing but it is a part of profit. So who is going to earn the profit? These three persons will earn the profit. In that profit, they have to keep some amount for future purpose. So that entire amount belongs to partners only. So this reserve fund, what we have to know, we have to get that will be transferred to the partners capital account. This amount directly reflected to the partners capital account. Next, capital details are given. So here A, B, C. So these three things will becomes to the partners capital account only. Which side it will come in? So here in the previous balance sheet, the what the transaction will be affected or located into the left hand side. The entire transaction will be transferred to the right hand side of the next account. Let's come to the asset side. Here cash in hand they are given. So cash in hand, actually this one is a current asset, but in the last adjustment something they are given. So here the retiring partner is to be paid his dues in cash. So how is the partner is retired, for him we will pay the cash and we will settle the amount. So this transaction will come to the cash account only, because if we are settled in cash means we will prepare cash account. If we settled by check means we will prepare bank account. So during that time the transaction will come to the cash or bank account, that will be considered as an opening balance. If we won't pay cash, if we won't pay check, during that time the dues of the retiring partner will be considered as a loan. So that amount transferred to the balance sheet, and also this cash in hand and cash in bank, as it is we have to transfer to the asset side of the new balance sheet. Here there is no addition, there is no deletions also, and remaining all assets will come to the new balance sheet. So all the assets including the current asset as well as the fixed asset, the assets will come to the new balance sheet only. For this assets and liabilities, if any adjustment is there, means that will come to the revaluation account. Let's move to the further information. So here C is retires from the business. So out of these 3%, C is going to be retired. First we have to think about it. Next, second thing is, so the share of C is 1 by 5. 1/5 share is the C share will be there. So C retires from the business. Why the C is going to retire means due to illness, and the following adjustments are agreed upon. So C will not feeling well. So for that sake, the partner C will not ready to continue in their business. So C is decided to retire from the business, and also some conditions he has to be implemented. That conditions will be agreed between the company and the retiring partner. Both the persons and both the partners and the company has been agreed upon this adjustment. So what are those conditions means? Condition number 1, it will say that depreciate machinery and furniture by 5% and 10% respectively. So this is the new adjustment. In the previous admission of a partner, that chapter also, directly they are getting depreciate machinery by particular percentage, depreciate furniture by particular fixed percentage. But here they are given, first they are given the name of the asset, that is machinery, and the furniture they are given. So later percentages they are given. The first percentage come to the first asset, and the second percentage will come to the second asset. So directly we have to consider for machinery 5% is the rate of depreciation, and for furniture 10% is the rate of depreciation respectively. So depreciation is nothing but expenses. So income and expenses deals by a particular account. That account will be considered as a revaluation account. So it will come to the revaluation account. We have to come to know. But in the revaluation account, where it is going to be affected in the revaluation account, these kind of the any expenses will comes to the debit side of revaluation account. Debit side of revaluation account. We have to record it twice by a particular adjustment. First we have to write debit side of the revaluation account, and the same thing where we have to write this, we have to write in the balance sheet. We should deduct the depreciated values what we have to calculate it in the revaluation account. What the values we have to get in this account, that will be deducted in the balance sheet of new form. That is the first adjustment. Adjustment number 2. Stock and furnished buildings are increased by 10% and 20%. So here also two assets they are given, stock also given and buildings also given, but their value will be increased. The term he used increased. Sometimes they are given valued at, during that time the exact value they have to given, so we have to compare the value. But here what the term is used, so increase is given. Increase is nothing but appreciation. Appreciation is nothing but income to the company. Incomes will deals by a particular account, that will be called as a revaluation account. So the revaluation account, where we have to record it, expenses always come to our left hand side and incomes always come to our right hand side, that is credit side of revaluation account. We should write here credit side of revaluation account. First credit side we have to write once. Again where we have to write in the balance sheet, new balance sheet, we should add the value. What the value we have to get in the revaluation account, that value we should add it to the new balance sheet. That is related to the second adjustment. Let's come to the third adjustment. Adjustment number 3. What it will say means provide PDD. PDD is nothing but provision for doubtful debts or reserve for doubtful debts. They will best like this only at 5% on debtors. So here the term debts is nothing but expenses, dues. What the amount should be due to the company, that amount should be called as a debts. So debts is nothing but expenses. Expenses always come to which account? Revaluation account. Which side we have to record it? Debit side we have to record it. Again where we have to deduct this value under balance sheet. We we should minus, we should deduct the same value. So adjustment number 3, first which will be affected to the revaluation account debit side. In the balance sheet, we should deduct that value what we have to calculate it. Percentage is given. Sometimes value is given, means we should consider value directly. Sometimes the value is not given. Instead of value, some percentage they are given, means we have to calculate the percentage. Let's come to the adjustment number 4. It is new adjustment. It will say that a provision of rupees 950 is made in respect of bill. So here repaid bill. Which bill is they are given? Repaid bill. So here they are given a provision. A provision is nothing but compulsorily we have to pay. Why we have to going to pay means is made rupees 950. How much we have to make provide pay? 950 is made in respect of repaid bill. So one of the machinery is going to be spoiled. It is going to damage. So for the replacement of that machinery, for the renewals and for we want to get the work of that machinery, we have to make it to the repair that machinery. For that repairs, the cost is 950. So here what is happened here? Machinery is an asset. So here asset we are paying something. So for what purpose we are paying that money? So for the repair purpose. So here what will happen? Cash will goes out to the business. So whenever we have to pay our income to the third person, it is an income or expenses. Whenever we pay the money to the outsider, so it is an expenses. The outsider will pay money to us, it is an income to us. So here 950 is paid, it is in respect of repair bill. So a provision of this 950 is made, that is compulsory we have to pay in respect of repair bill. So this adjustment will be considered as the expenses only. First we have to write revaluation account. Which side we have to record it? Debit side. First we have to record it debit side of revaluation account. Because value directly they are given. So this repairs will not be affected in the previous balance sheet. So here there is no addition and deletion. Second thing we have to write. Where we have to write means in the balance sheet. So which side we have to write? Under liability side. So in the adjustment number 4 we should write 2 places. Point number 1. First where we have to record it? Under debit side of the revaluation account. First we have to write. Second way we have to work with, so credits, in the balance sheet, liability side we have to do 2 times we have to record it into the adjustment number 4. Let's come to the adjustment number 5. Here, goodwill of the firm, the term they are given, goodwill of the firm rise for rupees 36,000 they are given. The same adjustment we have to decide it and we have to discuss in the previous chapter, that is admission of a partner. Here the goodwill of the firm's goodwill they are given. The 3 partners including retiring partner has to fix one value rise for rupees 36,000. So in this 36,000 all the partners will have a right. Okay, so the 36,000 we have distributed all 3 partners according to their profit sharing ratio, that is 2:2:1. Okay, if the ratio is not given, we should distribute it equally. So here adjustment they are given something here little liberally. So in the previous video also goodwill of the firm they are given. After that you have to continue the adjustment. What is going to tell? So create retiring partner share of goodwill and return of immediately. So during that time we have to treat different manner. But here what they are given, so goodwill of the firm is raised for rupees 36,000 and the same has been retained with the business. What the goodwill they have to create it, just they have to show in the books of account. So in that goodwill, what is the share of each partner, we have to calculate it. We are not paying, we are not withdrawing the goodwill, but the same amount is retained in the business after retirement of C. Also what the goodwill they have to create it, that kept into the same business and they are going to continue the business. Here there is no withdrawals of goodwill, so just they have to create it, again it should be continued into the business. So totally adjustment number 5 we should record at two places. One is partners capital account. Which side we have to record it? Credit side. Partners capital account credit side. Once we record it, again where we have to record it is in the balance sheet. We have to record it under assets. Under assets. So under liabilities asset side we have to record it assets. So totally the adjustment we have to write twice. Let's come to the adjustment number 6. What it will say is the retiring partner is to be paid his dues in cash immediately. Whatever the due to the retiring partner after his retirement, it is compulsory. We have to repay the amount. Sometimes we will pay by check if we have a sufficient bank balance. Sometimes we pay in cash if we have a sufficient cash balance. In sometimes we won't have the cash balance as well as the bank balance. During that time, we will transfer to his loan account and we have to pay it on installment basis, or else we have to pay it in a particular duration after 1 year, 2 years, along with interest we have to pay. So in this question, they are given the information that the retiring partner is to be paid his dues, what the amount he has to receive for their account, that amount we have to pay in cash only. So immediately we have to pay the settlement to the retiring partner. These are the conditions they are given, so that conditions will be agreed both the retiring partner and remaining partner. So finally what we have to prepare means prepare revaluation account. First account, income and expenses account we have to prepare it. That account, in that account we have to know about the profit or loss on revaluation of assets and liabilities. Revaluation, again we have to implement a particular value of a particular assets and liabilities. And also here partners capital account, second account, how the accounts will be settled, how the accounts will be separated, what is the beginning balance of particular partner, what is the ending balance of the particular partner after retirement of a new partner. And also cash account, here cash account is compulsory. In the question itself, examination point of view, they didn't ask to prepare cash account, means even though then also we have to prepare a cash account. Why means because they are settled in cash only. If we settled by check means it is compulsory, we have to prepare a bank account also. If these two accounts are not necessary, when it is not necessary means if we are not paid cash or we are not paid in check, so bank or cash account is not sufficient. Efficiently we have to prepare, it is not compulsory, but we are paid in cash or check, cash or bank account is compulsory. And balance sheet after retirement, after retiring of C, we have to prepare a new balance sheet also. Next we have to move to the solution related to the particular question related to the same information. So let's we have to move to the solution. So here they are given. So first account what we have to prepare, we have to prepare the revaluation account. First draw the columns for revaluation account and write the heading first itself, revaluation account, and we have to fulfill all the conditions while we have to prepare the account. Draw the columns for revaluation account. We should write the heading, draw the columns in your notes, class work, and for revaluation account. Revaluation account. So here the condition is debit side, credit side we have to note. Under debit side we should write particulars, amount. Credit side again particulars, amount. Column is debit and credit we have to write compulsory. So entirely revaluation account is totally depending upon adjustments only. So already we have to classify the adjustments. We have to divide the adjustment. Which adjustments come to which account. So here out of that, so totally 4 adjustments will come to the revaluation account. Remaining 1 adjustment will come to the partner's capital account. Another adjustment will come to the cash account. So totally 6 adjustments are there. We have to do it differently. First we have to divide this. It is very easy to solve the 12 marks question. If we are not divide directly, we will do the solution. Sometimes it is possible, sometimes it is not possible. So we have to move to the exact procedure. So here, adjustment number 1, what it will say is depreciate machinery and furniture by 5% and 10% respectively they are given. So here we have to calculate the depreciations of all the assets and liabilities. So here depreciation is only given for the assets and appreciation also only given for the assets only. Let's we have to discuss about the depreciate machinery. The value of machinery is available in our question, that is previous year balance sheet they are given. So the value of machinery is 25,000. Out of that 25,000 we have to create 5% depreciation. So depreciation will comes to the expense, consider as the expense, and expenses come to our left hand side, that is debit side of revaluation account. So we will write the heading 2, depreciation of machinery. Depreciation of machinery. So here the value of machinery is 25,000 into 5%. 5% we have to write, or 5 divided by 100 we have to write. So first we have to calculate the value. So 25,000 into 5% we will get 1,250 rupees. Like that, 25 to 10 means 2,500. So in that 50%, half means 1,250. So first adjustment, so half we have to complete it. And again they are given and furniture by 10% respectively. So second asset they are given, second asset for the second percentage is given, that is 10% for furniture. The value of furniture is available in our previous balance sheet, that is 11,000. So here we have to write, so depreciation is expenses, it will come to the debit side. 2, depreciation of furniture. The value of furniture is 11,000 into 10%. So we have to calculate this value. So depreciation of furniture. So 11,000 into 10%, we will get 1,100 rupees as a depreciation. First adjustment, we complete the process. Let's come to the second adjustment. Second adjustment, what it will say? Stock and buildings are increased by, increased they are given. Increased is nothing but appreciation. So appreciation always come to the credit side of which account? Revaluation account. So first we have to calculate the values. They are not given the exact value. So instead of value they are given some percentage, some rate they are given. According to that rate we have to calculate the appreciation. And we should write here by appreciation of stock. First term they are given stock. Appreciation of stock. So the value of stock is 10,000 which is available in our previous balance sheet under the asset side only. We should write in the inner column the value of stock is 10,000 into the rate of depreciation is 10%. So we have to get 1,000 rupees as a appreciation of stock. The value of stock is increased up to rupees 1,000. Next, in the same adjustment, one more thing they are given, and the buildings are increased by 20%. Here they are given some percentage. The value of buildings where we have to get in the previous balance sheet they are given under the asset side only. The value of buildings is 70,000. So for that we have to add the value of 20%. So we should write like this: by appreciation of buildings, the value of buildings is 70,000. 14. Exactly, we will get 14 as it is 4 zeros, 3 zeros we have to write. So coming to the 14,000 is the appreciation of buildings. Adjustment number 2, we complete the process. Let's come to adjustment number 3. What it will say is provide PDD at 5% on debtors. They are given provide rupees 5,000. Sorry, 5%. Provide at 5% PDD on debtors. So debts is nothing but expenses. Expenses come to the revaluation account, debit side. To PDD on which value? Debtors value. So at what rate they are given? 5% they are given. So here the value of debtors is 30,000. In bracket we should write 30,000 is the value of debtors into rate of debts is 5%. So therefore we have to get one value, that is 1,500 rupees is the debts which we have to deduct in the debtors after while preparing the balance sheet. Next, adjustment number 4. What it means is a provision of rupees 950 is made and a respect of repair bill. So that amount they will not pay it previously. After during the time of retirement, we compulsorily paid the settlement and we have to settle the dues. So that the due cost is 950. When we pay the amount to the outsider, so that is expenses to company, we should write under revaluation on debit side to repair bill. The value they are given directly 950 rupees they are given, so directly we have to pay. So adjustment number 4 is completed. Fifth adjustment belongs to goodwill. Goodwill belongs to all partners, so it will come to the partners capital account. Settlement made by cash, that is also belongs to particular adjustment, that will comes to the cash account only. 4 accounts, 4 adjustments will be there, that 4 adjustments we have to transfer. Now it's time to close the revaluation account. How to close the revaluation account? By giving the space what we have to wrote in the debit operating side. For minimum 3 to 4 lines we will give the space. Later we have to close the account. So here I will close here. So before closing that, just you have to assume which side we have a highest value. Whether we will get a higher balance in the credit side or else we have to get the highest balance in the debit side. The total of credit side we have to get 14 plus 1 15,000. By adding all these 4 values, we won't get the value of rupees 15,000. So credit side only we have a highest value. So we should make the total of imbalance. So if we know that credit side we have a highest value, means we will get the profit only 14 plus 1 15,000. 14 plus 1 15,000. Same values we should write debit side also 15,000. 15,000 deduct 4 values, we will get the difference. The difference we will call as a profit. To any partners capital account. In bracket we have to mention that profit. What is this value is? It is a profit to the company. So how much profit we have to get? So out of 15,000 minus 950 minus 1,500 minus 1,100 minus 1,250. So finally we have to get 10,200 rupees is the profit which we have to get in the present year while we have the revaluation of the assets as well as the liabilities. Here there is no liability, only assets they are given. So for that we will get a profit of rupees 10,200. So for this 10,200 we have to distribute it between the partners. So here 3 partners are there: partner A, partner B, partner C. So by distributing the values, making the before totals, behind that we have to write, but we should write in the inner column itself. We don't write the outer column because sometimes it will create a confusion. So here the A, B, C, 3 members of the partner. So out of this 10,200, all the partners will have a right to distribute this value. Then they will have to get the profit or losses. The ratio is 2/5, 2/5, and finally 1 divided by 5. So while distributing this value, first partner will get 4080, 4080. Again second partner will get 4080. Second partner will get 2040, 2040. While adding these three values, again we have to get the same value 10,200 only. So if it is not get the same value, means we did a wrong distribution. If we will get the equal value, means we will do the right distribution. So like this we have to prepare the first account. We will complete the process while preparing the revaluation account. This is the first phase. First account we have to complete it. Let's we have to move to the preparation of the second account, that is partners capital account. While preparing the partners capital account, we must and should follow some steps. Step number 1, opening balance we have to transfer. Step number 2, undistributed reserves or profits, anything will be there, means we have to distribute it. Step number 3, so any adjustment related to the partners we have to transfer. Step number 4, in the revaluation account, what we have to get the difference, that is profit, which may be loss. So debit side balance or credit side balance we have to transfer to the partners capital account. Later we have to close the retiring partner capital account. First we have to close the retiring partner capital account. Later we have to close the remaining partners capital account. So here both are rhyming words only, retiring and retain. So retiring is different, retain is different. Retiring is the partner exiting from the business whose account we have to close. Remaining partners means the partners continue the business for their account we have to close later. So like this manner we have to prepare the exact partners capital account also. Let's we have to move to the preparation of the partners capital account also. Let's we have to prepare the columns for so partners capital account. So we should write the heading partners capital account. Partners capital account. We should draw the columns for partners capital account. Partners capital account. So A, B, C. Particulars A, B, for partners C. We have to draw the columns for all the partners. We should draw the columns for 6 to 8 lines. 6 to 8 lines we have to draw the columns for partners capital. So in the partners capital account, first we have to fulfill the all conditions. So we should write debit and credit also compulsorily. Particulars partner A, partner B, partner C. Again, credit side also particulars, partner A, partner B, partner C. So 3 members are the partners. So in the partners capital account, step number 1, what we have to transfer is opening balance we want to transfer. Without opening balance, it is not possible to open an account. So for that sake, we have a minimum balance, so that is available in our question. So directly we have to transfer here. So we should write by balance brought down. By balance brought down. The capitals which is available in our previous balance sheet, that is rupees 50,000 for partner A, 50,000 for partner B, and rupees 30,000 for partner C. So out of this, so these values, step number 1 we have to transfer the opening balances. Step number 2, while preparing partners capital account, what we have to transfer in the previous balance sheet, some undistributed values they are given. Which of those undistributed values mean they will given under liability side by the 3 names. They will call 3 names. One is reserve fund. Number 2, general reserve. Number 3, sometimes they will be given profit and loss account. Out of these 3 terms, they can use under liability side. In the asset side, they can use only one value, that will be called as a profit and loss account. If it is asset side means that also we have to distribute it. So here general reserve and reserve fund always will be affected or located in the liability side of the previous balance sheet, that is left hand side. But profit and loss account, sometimes it will be located in the asset side, sometimes it is located in the liability side. Based on that situation, we have to adjust according to that criteria, according to that stimulation. So let's we have to know in this question what they are given. Reserve fund is given. That fund we have to give to all the partners, because in the retirement all three partners will have to make an agreement and understanding to keep the amount for future purpose. So we have to keep that value to the all the partners. But the same adjustment will come in the admission of a partner. We won't distribute it to the new partner, because the entire credit goes to the old partners. In the retirement, including retiring partner, all the partners will have a right to distribute the undistributed profits as well as the reserves. So here they are given reserve fund. We will write by reserve fund. Reserve fund. The value of reserve fund is given in the old balance sheet under liability side, that is rupees 24,000. 24,000 into their ratio is 2:1. The profit sharing ratio is 2:1. So now what the value we have to get by particular partner? First partner will get 9,600 rupees. Second partner also will get 9,600 rupees. The third partner will get 4,800 rupees. So out of this 24,000, we will get 2:1 the ratio. So first partner will get 9,600, second partner again get 9,600, third partner get 4,800 rupees. So according to this manner, we have to distribute the value. So first this is the calculation. Next. Step number 3, what we have to get. So remaining no another nothing they are given into the previous balance sheet. Let's come to the adjustment. In the adjustment number 5, we have to express that. So what they are given, goodwill of the firm is raised. They are given rise, value, created. 3 terms they can be used. But how much they are given? The goodwill of the firm is raised for rupees 36,000, and the same retained in the business. That means the value should not be withdrawing. That should be kept into their business only. So we have to adjust that adjustment. We will give the name we call by goodwill account. Goodwill account. The value of goodwill is 36,000. This 36,000 we have to distribute it according to the profit sharing ratio 2:1. 36,000 into 2:1. We will get so 14,400 for one partner, 14,400. Again 14,400 for second partner. The third partner will get 7,200. While adding these three, again we have to get this 36,000 only. If we won't get this value, means we did a wrong distribution. We have to assume like that. If it is equal, means we will get a right distribution. So step number 3 is also completed. So remaining any adjustment is there which is affected to the partner's capital account? No, they are not given. But settlement we have to make in cash. So that will come later. Let's come to the first account, revaluation account. In this account we have to write a word to partners capital account. What is that? Profit. How much? We have to distribute it here. The entire thing we will get the debit side of the difference that will transfer to the credit side of the next account. We will write the name. From where the value we have to get means this value we have to get from revaluation account. Revaluation account. What is this value? We should write here also in bracket. Profit. How much profit? 10,200 is the profit. In that 10,200, A, how much share? B, how much of the share? And C, how much of the share? So first partner will get 40,000, 4,080. Second partner 4,080, 4080. Second partner 2040, 2,040 rupees. While adding all these three, we will get exact value. So totally we have to get. So in the credits, debit side of partner's capital account, any withdrawals is there means we should write here goodwill account withdrawals. They are not given. Suppose in the revaluation account, we will get the difference on the credit side. That is, we will get a loss means that loss we will transfer here. But in this question, we won't get any loss. So credit side, nothing will be there. Directly, we have to close the account. In the retirement, first we have to close the account of retiring partner. Later we have to close the account for remaining partner. Okay, but in the admission we should close the account directly for all persons. But in the retirement, first we have to close the account of retiring partner. So here retiring partner is Mr. C. Mr. C is the retiring partner. So what is the total of Mr. C? C will get the 44,040 rupees. While adding all this value, 44,040 44040. Same value we transferred here, 44040. 44,040 rupees we have to get. So if there is nothing is difference, the same value we have to transfer here, 44040, and we will give the name equal to cash account. First we have to close the account of a particular person. Later we have to close the accounts of remaining partners. So remaining partner A and B. What is the total of A now? 78,080. What is the total of B for him? We will get again 78,080. Same value we should transfer here. 78,080. 78,080. 78,080. Deduct anything is there means we should deduct. If it is nothing means we should keep the same value here. 78,080. 78080. For the second partner also 78080. For third partner I-1 because we won't have that value. So we will give the name for this value to balance carried on. Balancing figure. This value we have to find out. It will be given as a stop mark. What the balance we will consider as a carried on, the same balance we will transfer as a brought down by balance brought down. If anything difference, we should write the same value. Otherwise, we should write that as value what we have to get 78,080. For the third partner, we want balance carried on because we have to settle by cash. If we are not settled by cash, means it will be treated as a loan, so it will come to the new balance sheet. But in this question, we are settled. In the previous question, we have to settle by check. So in this question, we are settled by cash. So no balance brought down will come to the retiring partner. Now we have to close the columns for all the partners, including retiring partner. We have to close the columns for all three partners, including retiring partner. So like this manner, we have to prepare the partner's capital account. This is the exact value they are given. Now we have to move to preparation of the third account. Which is that account? Cash account. Cash account. And we will draw the columns for cash account. And we have to draw the columns for cash account. So we will write the heading. Debit and credit compulsorily. Columns is particulars. Amount. Particulars. Amount. Debit side. Particulars amount. Particulars amount. Let's we have to complete this account. For each and every account, we must should transfer opening balance in the first step only. So here we are preparing cash account. In the previous balance sheet, somewhere they are given the term cash. To cash in hand they are given. So not to just cash in hand they are given. whatever the cash in hand given, that is the opening balance of the cash account. Before that retirement, the company will have the cash balance. Out of that cash balance, they are settled to the retiring partner, and later how much of cash will be available for that analysis, we have to prepare the cash account. So cash they are given in the previous balance sheet, which side? Right hand side given. Now we transfer to left hand side of our account. So we will give money to balance brought down. So the cash balance is available in our previous balance sheet. They are given, that is rupees 55,000. So we have a cash of rupees 55,000. Out of 55,000, so we will pay to Mr. C. So here we have to write in the partner's return to cash account. For whom we are going to pay? For Mr. C. So now we are paying to C. So the value where we have to record the debit side of previous account. By transferring this value, if we come to the credit side of which account, we will write C's capital account. What the value we have to get is 44,040 rupees we have to pay. So we have a cash of rupees 55,000. Now we have to close the account. 55,000 we have. Out of 55,000, we have to pay 44,040 rupees to Mr. C. After payment, how much of cash is available in our business? The available cash is 10,960. 10,960 rupees. That should be available. We will do the name by balance carried down. By balance carried down. So we have to put this down because this value we only created. So we have a cash of 55,000. Out of that 55,000, we will settle to Mr. C by giving a cash of rupees 44,040 rupees. So after the payment to Mr. C, the available balance in our account, how much means 10,960. 10,960 is the present balance which is available in our business. The carried on balance will be considered as a to balance brought down. To balance brought down 10,960 rupees. After transferring the brought down value, we have to close the account of cash account. We will close the columns of cash account. So like this manner, we have to complete the third account. So first of all is revaluation account. Why this account is meant to prepare? To know about the profit or loss of revaluation of assets and liabilities. So now we will get a profit. First account we have to prepare. The second account purpose, why partners capital account is prepared, means to know about the capital balances at the end of the financial year, whenever it is admission, whenever it is a retirement or dissolution. During that time, why we have to prepare this account is to know about the capital status of a particular partner. So at the end of the every financial year, we prepare the partner's capital account. Cash account we prepared. Why we have to prepare the cash account is to know about the cash position into the business, whether the cash will be available sufficient cash or else we have to taken from bank or as a bank overdraft. For that everything we have to know, we have to prepare the cash account also. This is the second account. Next we have to move to the final touch of this account, means we have to prepare a balance sheet of after partner C's retirement. Next we have to draw the columns for the balance sheet. Next we have to draw the columns for new balance sheet. So here what is happening means, so while preparing the new balance sheet, it is totally based on the old balance sheet. What the steps they are given, according to that only we have to write, means we won't lose any kind of transaction. If we won't follow any steps, means we should write blindly, means it is the chances to omit some kind of transaction. Some transaction will be left. So let's we have to prepare the new balance sheet. We draw the columns. First we have to write the heading balance sheet as on after retirement, no, 1/4/2020. So because 31st March is ending date, during that date we have to settle. After settlement of that person in the new year, so next academic year we will get a new balance, that is called as a balance sheet of 1/4/2020. So come to the headings of the balance sheet. We will have to get liabilities and assets. We won't write the debit and credit to the new balance sheet because it is a statement, it is not an account. So in the previous three accounts, if we didn't write it, they will deduct the marks. Here, if we wrote the debit and credit, they will deduct the marks. So we will write liabilities, amount, assets, amount, assets, amount. So the liabilities side. First, what the transactions they are given in the previous balance sheet? First point is creditors. For this creditors, there is no adjustments. So directly we have to write the value to the amount column. The value of creditors is 30,000. We should write directly 30,000. After that, second thing they are given bills payable. The value of bills payable is 22,000. Second transaction they are given 22,000. Second transaction. The third transaction they are given, which is that means the third transaction is reserve fund is available in the previous balance sheet. But in the new balance sheet, you won't write the word reserve fund because that reserve fund we have to distribute it between the partners. It is already joined in the capitals of the particular partners. Now no need to write again because once we have to transfer it, that is sufficient. Once we distribute it, we won't consider that value. So here also we should write reserve fund. We won't write that value. After reserve fund, what the value they are given? We have a capitals. In the previous balance, how many partners capitals is available? 3 partners capital is available. Partner A is capital, partner B is capital, partner C is 3 members capital is there. But here, new balance sheet, we should write only 2 partners capital balances. We left 1 partner capital because who is going to retire means we have settled them. If we not settle this, we should write the separately C's loan amount. But here C is retired, we have to settle his dues by paying the cash. So C will not come to the new balance sheet. Now the available partners is only A and B. A's capital balance already we have to calculate 2 balance carried on. That same value we have to transfer as a balance brought down 78,080 78080 for partner A, 78080 for partner B, 78,080 rupees for partner B. So these are the information is available in the previous balance sheet. Adjustment is there, will come later. Let's come to the asset side. In the asset side, first transaction they are given cash in hand. We should also write the same heading, cash in hand. So we have a 55,000 of cash balance previously. After settlement of C, we have a cash balance of rupees 10,960 rupees is the present cash balance which is available in our business. Previous we have 55. Out of that 55,000, we settled to Mr. C by paying a cash. So after payment of C, we have a cash balance only 10,960 rupees is sufficient, which is available in our business. So second. Let's come to second transaction they are given. Stock they are given. Stock they are given. The value of stock is 10,000. For this there is adjustment, so we should write in the inner column of the balance sheet. Stock is rupees 10,000. For this, what the adjustment they are given? Stock is increased by 10%. They are given. We should add the value. Add appreciation. So value is 1000 rupees. 10,000 plus 1000. So final value of stock is 11,000. Final value of stock is 11,000. Let's come to the second transaction. Debtors they are given. Debtors. The value of debtors is 30,000, which is available in our previous balance sheet. For this, there is a adjustment number 3. Third adjustment they are given, that is provide at PDD at 5% they are given. So PPD is nothing but debts is expenses always deducted minus PDD at some percentage they are given at 5%. The 5% is 1,500. 30,000 minus 1,500 we will get 28,500. 28,500 is the present value what we have to get. This is second. Let's come to the third transaction. So one more transaction, one more asset is available. We will call machinery. The value of machinery is 25,000. For this there is adjustment minus depreciation 1,250 rupees. 25,000 minus 1,250 we will get 23,750. 23,750 is the present value of machinery after cease retirement. Next another is there. So bills receivable. So for this there is no adjustment. So directly we should write bills receivable value is 5,000. The value of bills receivable is 5,000. After that they are given value of buildings. The value of buildings is 70,000. We should write in the inner column because for this also there is adjustment and appreciation. So 20% annual 14,000 is the appreciation. Therefore 84,000 is the present value of buildings after Mr. C's retirement. Next point they are given furniture. The value of furniture is 11,000. We should write inner column because for this also there is adjustment minus depreciation. So 1,100 is the depreciation. 11,000 minus 1,100 we will get the value of rupees 9,900 rupees. So we will fulfill all the conditions which are available in the previous balance sheet. Next we have to come to the adjustments. Adjustment number 1, what it will say? Depreciate machinery and furniture by 5 and 10% respectively they are given. So once we have recorded revaluation amount, debit side we will calculate the percentage values. But the same values we should deduct it in the balance sheet also. For machinery we will deduct it, for furniture also we should deduct it. So 2 times we have to record it. First adjustment is completed. Let's come to adjustment number 2. Appreciate stock and buildings they are given. So once we have to record a credit side of revaluation amount, we find out the values. Again we should add it into the new balance sheet. For stock also we should add it, and for buildings also we should add it. 2 times we have recorded. Adjustment number 3. Provide PDD at 5% on debtors. Once we recorded into revaluation account debit side, we calculated the value. Again we should deduct it in the new balance sheet. 2 times it is completed. Adjustment number 4. Provide rupees 950 for in respect of retail bill. So once we record it under revaluation account debit side, again we should record it under liability side. Repair bills. Repairs bills. Value is 950 rupees. Adjustment number 4. Adjustment number 5. What it will say? Goodwill of the firm is Raised rupees 36,000 they are given. First we have to raise the goodwill and we have to distribute the goodwill, that is 2 is to 2 is to 1. So 2 is to 2 is 1 is 14,400, 14,400, 7,200. We will get the same value. Again the same value we have to transfer to the new balance sheet by giving the particular name by goodwill itself. So we will write here goodwill. The value of goodwill is 36,000. 36,000 is the value of goodwill. Adjustment number 5. Last adjustment is there. The settlement of retiring partner dues is paid by cash. So here we are paying the cash. First we have to calculate the value cash. How much we have to pay. Later we have to settle the cash. And finally we have to know what is the present cash position. 10,950 that should be available in our balance sheet. It's time to close the balance sheet by closing the particular accounts. So first we have to make the total of all the liabilities and later we have to get the total of all the assets. The total of liabilities is 30,000 plus 22,000 plus 78,080, 78,080 and 950. We have to get 2,09,110. So for this also, for the assets also we have to make the total cash plus stock plus debtors plus machinery plus bills receivable plus buildings plus furniture plus goodwill. Again by adding these three, so we will get one exact value 2,09,110 rupees. So like this manner we have to prepare the balance sheet if any new adjustments they are given into the particular question. So I think you people have been and understood exact proper distribution and proper manner of the question for the sake of the preparation of the new balance sheet while they are giving the new adjustment in case of the acquisition of retirement of a partner. So in the next video also we have to discuss in the same chapter by getting the different new adjustments. So